Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
James and Wojtek from US Properties. How are you guys doing?
Excellent. Thank you.
Doing really great, Sarah. Always a pleasure to be here.
Yeah, I always love having you guys on. You are doing amazing things out in Detroit in the US. And, there's always some changes and there's always things that happen. So it's just important to keep a pulse on all the different markets and the different strategies. And, there's maybe somebody new also listening to this that may not have heard of you guys before and what you do. So maybe just a quick 30,000 foot view to start, if you don't mind.
Sure. I mean, we're US Properties.CA, so we're a Canadian-based, boutique real estate company operating predominantly in Detroit, Michigan. So I think what defines us really is that we're a full turnkey operator. We've been focused heavily in the Detroit marketplace going on 6 years now. Everything that an investor would need, from entity formation, for US tax reasons, through property selection, construction, property management, insurance, and so on, we have in-house, right? So we really help with our end-to-end system get investors set up from the contemplation stage all the way through to actually being a cash flowing landlord, right? Essentially we're in Detroit for cash flow. Like a lot of Canadians, we were looking for that, and we were struggling to where the next deal would come from, where the cash flow lied and the price of acquisition. So we heard of Detroit, we went down, we liked what we saw, we started buying. It didn't take us very long to realize that this was real. And, long story short, here we are 6 years later, 500 properties and 500 renovations into what has become quite an endeavor and a really successful one for ourselves and for our investors.
Absolutely. That is awesome. So essentially, if somebody wants to, a Canadian, invest in I would say, easier acquisition market in the sense that the price points are less expensive. Yes. And I think there is still some cash flow. We can talk about that as well. They would come to you. You have all the Canadian systems down of how Canadians can invest in the US, and you essentially could provide them a fairly turnkey opportunity.
It's 100% turnkey. That really is what defines us, as our experience, the infrastructure that we have, the team in place. But really, I keep saying it over and over again, but everything you would need to go from listening to this podcast to getting set up correctly to invest into the United States and being shown where to invest in the right neighborhoods, what assets we think would be a good fit for that individual investor, what the returns are like, and getting you, set up and guided through the acquisition process all the way through to owning and hopefully scaling, which a lot of people are interested in doing with us. We sort of guide you step by step.
Okay, awesome. So I know we've had you on before, and I think the first time these price points were just insanely low, and I'm sure they're not as high as they are today in Canada as an example, but what can somebody expect? Let's just talk about numbers. What are you buying? What price point, and what does that look like?
Well, look, we have some different asset classes that we operate in. Surely, where we've had the most success is in the single family market in sort of B class. We call them quote unquote high appreciation hot pockets, right? In those regions, we're operating mostly in colonial homes. Typical cost for an investor coming in would be between 130 to 160,000 US. Okay, you could either buy outright and then refinance after purchase in 6 months. You do a cash out and scale, or we have more accessible purchase financing options for foreign nationals to come in and buy with a 30% down payment. After that, there is a more premium class of properties. The advantage to these ones is, and we'll talk about this a little later, I think, is there's potential for a little bit more equity capture from purchase due to construction and neighborhood class. So they can range anywhere from that sort of 160 level up to around 250,000 US. Okay. Below that, there is a very stable entry level asset that typically runs around 95 to 100,000, typically a bungalow. They're very attractive cash flow assets, low maintenance, but they're not always the best for, or should I say, as successful with the scaling model, because when it comes to the US lenders, they like to see a little bit higher valuation on the appraisal, and they just don't perform quite as well due to the fact they're not going to be in quite the same neighborhood quality.
Mm-hmm. Anything you want to add on your end, Wojtek?
Yeah, I think that, we've really, as the market has matured, we've noticed that there is more equity to be captured by investors in these slightly more expensive properties. So, for instance, you can buy a property right now with, for 130,000 and end up with about 8-9% cash on cash return. But if you we had clients who are buying $225,000 assets that are worth about 275, so they're able to purchase at 225, even with financing, with 30% down. And 6 months later, they're able to get another appraisal. And then that appraisal value, of course, is taken when doing the refi with the same lender. And what's been really, really successful with this particular asset class is that, because we're working directly with the lenders now, the loan fees have been virtually zero. They're charging 0.5% of the loan value, whereas it used to be 3 or 3.5% before that. So, so a lot of the equity capture was eaten up by lender fees. Right now, we're having a lot of success. Our clients are able to experience the equity lifts, which turn into higher LTVs. And so, we have clients who are able to come in with $150,000, $175,000 in cash and end up with 4 $250,000 properties at the end of the year in a 12-month period. And they're thrilled, and they're all cash flow positive, and they're all in even better neighborhoods than we were operating in before, with higher appreciation potential. These assets are located closer to downtown, 5-10 minute drive from the downtown core, and that's where we've seen the highest rent growth and the highest appreciation right across the board. So it's been fantastic. It's been really great in the last 12 months. I know a lot of your listeners may be concerned about the increasing interest rates and about what that environment looks like and the impact that it's had on cash flow. What we have really been focused on in the last 12 months is really controlling other costs, such as insurance. We've gotten our clients half the insurance costs that they were paying prior, in the last 6 months, and that has had a very positive impact on the cash on cash returns, even though the interest rates are a little bit higher. And also the elimination of the lender fees. That combination has virtually been able to produce the same returns for our clients as we have been over years. And as James mentioned, the impact in the US of the high interest rates has been present on higher value properties. And of course, the $2, $3, $4 million homes, well, the prices have been impacted. But in the market, in the pure investment market of $100,000 to $150,000 properties, we have actually seen steady increases over the last 2 years. They're not in the high double digit appreciation that we have experienced, but we're still getting 8, 9, 10% increases on the properties, despite the environment. So it's very exciting, and we've been very busy, for the last 8 months, like it's, because of it, I think so. And our clients are having a lot of success.
So obviously you mentioned the increases in price. What about the increases in rents? I mean, obviously, with everything being so expensive in Ontario as an example, like the rents just have skyrocketed. Like what, and I'm assuming it's maybe not exactly the same where you're operating, but like, what are you seeing from a rental standpoint?
Yeah, so what's great is, first of all, there's no rent control in Michigan, right? So you're able to increase every year. What we've found is that the market rents have gone up significantly, and because we deal with Section 8 and government funding, Section 8 is forced to provide increases to clients that match the market and the comps in that area. So without moving the tenants out, every year we can approach an agency and say, look, guys, well, here's a $1,400, $1,500, $1,600 rentals within half-mile radius. you have to match it. And 99% of the time, they're matching the increased rents. So our clients are really happy because, they don't have to deal with turnover costs and any repairs that the previous client may have caused. They're just continuing to roll with the same family, but in some cases we're seeing 10% annual increases in rent. So it's fantastic. The rents have really gone up in Michigan.
Yeah, I would just add to that. I mean, it's exactly the line I was thinking about when we were talking about some of these larger homes that we're selling with the equity capture. Some of these neighborhoods where these homes are located are closer to Midtown. So some of these higher interest rates have really caused us to branch out and look for where the returns lie. And some of those homes, they benefit from considerably higher rent, right? So we're doing everything that we can to ensure the return on investment. There's actually quite a bit of good that's come out of sort of the last year and in some of these times. So we're starting to get into some areas where the homes really produce amazing appreciation, amazing equity capture, really good return on investment. And some of these areas too actually have considerably lower property taxes. So we're doing everything that we can to present a product that offsets today's interest rates, and the returns are still very strong.
What about from a cash flow standpoint? Like, what are you seeing? I'm assuming you're factoring in there's going to be costs, right? Taxes and insurance and property management. But like from an average, I would say net cash flow per month, like what are people seeing?
Well, I mean, we do the pro formas very accurately, right? So when we pick up a property and Wojtek's coming to me and saying, James, I have something here, the first thing we do is do a real analysis on it to see where it's at, where it stands with the property taxes. And then, of course, he sends the contractors in to assess that it's going to be good for our investors. But we're typically seeing on our standard homes, a sort of after all deductions, we're sort of netting, on average, 900 to 1,000 US if it's unleveraged. Okay, so that's good. So that would be, around an 8% cash on cash return.
And unleveraged means that you don't have a mortgage on it, essentially.
That would be coming in with funds from Canada, however acquired, like through a refi here, through a JV partnership, through life savings, through whatever means to come down to the United States, purchase your first home with the intention of then refinancing it with us, which is a very common play, sort of 6 months after purchase, extracting that capital back out of the home and doing it again. Okay. It used to be that, so with the rates, that the mortgage would take half of the cash flow. It's a little bit more right now, but typically, you're still looking at 300 to 400 US positive cash flow a month if you're coming in, with a financed acquisition. All right, or of course after you've refinanced and pulled that money back out. Some of the larger ones, it's even better. Okay, so this is a great thing that's going on with our properties near to Midtown. The rents are more expensive. Sorry, not more expensive, but the rents are higher. So it's yielding a little bit more of a leveraged return, which is very attractive. We've also branched out into some premium duplexes, which is something that came about for our search for better returns. Within these B-class neighborhoods we operate, there are some smaller multis that that can attract. Instead of $1,450 or $1,500 in rent, we're up to $2,000 or $2,100. That looks a lot better on the leverage side of a pro forma, right? So where we have basically really being a single family operator, we do operate in some more premium 2 units as well. Yeah.
So is it just still Detroit that you guys are focusing on, or Michigan, or have you branched out to other areas?
So we have an operation in Florida as well. Delivered a bunch of homes to investors. So if your listeners have an interest in that state, we absolutely have a great team there with amazing contractors. We have really good property management. We can deliver the homes. One issue we have found with Florida is that it's with the current rates, it's difficult to get cash flow. If someone is not looking for cash flow and they're maybe considering, turning the property into a short-term rental or perhaps just being cash flow neutral, and with the hopes of refinancing in a couple of years once the rates have come down, then we do have great options. We've just found that any property we looked at once it's renovated, it does, you're looking at zero cash flow, all your expenses paid, but that's where a lot of the experience has been in Florida in the last 12 months.
Okay. Are you planning other expansions aside from that, or are you going to stick to what you know and do best?
I think, we keep looking at different markets in the US. We always come back to Michigan because we have a really good infrastructure there. I feel that our contracting has gotten better. It was, post-COVID, a lot of the labor has come back to work and things are churning much faster. And we're really happy with the quality of the contracting. And we also have amazing management options. So should we explore other states? We can. It's just, it takes 12 months to set up that infrastructure. And then, you're not going to get it perfect the first time around. So it's a bit of a trial and error. And we do find that by going to similar states, like Atlanta or Ohio, or, even Buffalo, upstate New York, who have similar returns, each one of them have some drawbacks. Some of them, the properties are just more expensive and you're getting far worse returns. Or some of them are just small, such as Buffalo, where, you're essentially dealing with a city of 250,000, which is not, I mean, I wouldn't use the word hopeless, but it's not showing as much potential as something like Detroit with a 6 million person population with huge investment coming in, and an entire downtown has been completely rebuilt. I mean, you just don't have that in some of these other markets. You have some investment, but it's not the same caliber. So every time we look at one of these other states, we come back to Michigan and say, okay, you know what, this is actually really good, and has all the check marks of longevity. And so, we've made a plan to continue growth in Michigan for the next 10 years, and really stay and really continue to build infrastructure and help, customers and Canadians build large portfolios where we're really set up now that we can scale for people. We can work with busy individuals, professionals, part-time real estate investors, full-time real estate investors who are really looking to build a 20, 30, 50 unit portfolio in Michigan without time involvement, just coming out with the down payments, and then recirculating the money and refinancing the portfolios a lot, and using some of the equity that we continue to capture as the market matures.
What are some of the challenges? I mean, if somebody is looking to scale, like you're mentioning, to 30 to 40, and, they're in Canada and they're just getting started, like what are some of the challenges they might face along the way?
So, I think that for some people, it's the fear of the unknown, and just coming into a market where you don't know structures and don't know the right setups of entities and your companies, and kind of getting people past that hurdle. I think, we have so much experience in that department. We've done so much research and really made sure that we have the legal teams and we have the accountants and we have everybody that can help anybody accomplish that goal. So I find that that's number one issue, and just, being experienced and patient, and, look, you're dealing with property, and you're dealing with people. So sometimes there may be a little delay with construction, or sometimes there may be, a tenant who's moved in and, 8 months later, they're moving to a different state. And so now you have to re-tenant. So I find that as long as people have long-term vision and are able to just trust the process, it works 100% of the time. And because we have the resources and the teams to fix any problem on the ground now and to resolve any issue. So we can really help. And I find that, for most, it's just patience, and delays sometimes occur, and you have to be patient and just work through the delay, and just be prepared that sometimes things will take a little bit longer. But outside of that, things have been running very smoothly.
Yeah, I would think too. I just add that I think that we're just continuing to mature as an operator, right? And in our team and our network, everywhere from the lawyers to the lenders, it's just getting better and better. I think we're at a really good place right now. So for any people, especially for the investors that come in that want to scale and grow that portfolio, we're really set up for it. Okay, we've just done it time and time again. We're using the right assets in the right neighborhoods that perform well. So they're getting the good appraisals and they're getting the equity to pull and get more properties. And I think really, I can't reiterate enough that we have some really good lending partners who are reliable, very fair in their rates, and their timelines are, we just got to submit the documents, make everything compliant to fund, and then it just funds and very pro-business, right? So we're all set up.
Quickly, quickly within, we've gotten the lending timeline down to 30 days now, provide the client is able to, actually, provide the documents that have been requested. And we really help with that as well, because some of them are coming from our attorneys, etc. But James has been amazing at that. And really, we have worked with a lender and we've given them a 30-day timeline. And we said, look, if we're able to order an appraisal today and get you all the documents over the next, let's say, 7 days, are you able to fund us, if we started today by the end of August? And the answer is always yes, because they have, it's a very large lender with, very deep pockets. And so we're able to move through the process. And so it's much faster than what's happening in Canada right now. I know people are getting delayed on their refis right now. And, these secondary lenders are causing a lot of issues and not renewing people's mortgages that second and third mortgages that they've taken on their properties. And it's creating a big mess, and whereas we find that the lending options in the US are far broader and far more experienced. And once a lender lends to you once and you see that you're performing and you're able to pay your mortgage, they will give you unlimited amounts of money for subsequent purchases, which is what makes the US market so exciting, that you can continue to really grow and to scale and not be limited by the Canadian banks.
But there's got to be some risks, right? I mean, there's risks of the economy, there's risks of the, inflation, there is likely some, interest rate hike risks and what's going to happen in the market. Like, what do you foresee as some risks? There's something in any market, right? And some downsides. Like, what do you guys see?
Absolutely. Yeah, I think, we, as far as, economic downturn, that's a risk, right? You have, jobs being lost, and high inflation and increasing lifestyle and life costs, right? We have found, I mean, the inflation has been decreasing in the US very steadily. Now they're down to 3%. Their goal is to get it down to 2%. So yes, there will be another, quarter point increase, and there may be another one after that, right? What we feel that we have offset that with Section 8 and government rent, by really having majority of the portfolio covered, and the government will continue to pay rents, even though economic times may be tougher for that particular individual. We continue to, as these interest rates do increase, so do the rents, fortunately, and they have been falling on Section 8's shoulder, the increases, so we're able to cover the additional rent. So we feel that that's a big safety net for us. And of course, you are going to get some vacancies here and there. You have tenants moving out. We always recommend to all our clients to put aside, a bit of a kitty for emergencies, for things that might pop up. Should you be vacant for 2 or 3 months, you can still cover your payments and you cover your mortgage. Don't max yourself out. Don't have 100% of your funds, in real estate and zero in the bank, because it's a bit of a recipe for disaster, especially long term, and I know that real estate investors get excited, and once you start buying real estate, you continue doing it and you want to invest all your money because you realize it's one of the best investments on the planet and one of the best vehicles. But we always tell people, look, if you have some savings where you can, should things occur, you can get yourself through the storm, then you'll be fine. And long-term success is, is almost guaranteed, I would say. Yeah.
I mean, real estate's a long-term play, regardless of most of what you do. And if you're trying to do it short-term, I mean, that's there's high risk in any of that stuff as well. So if somebody listening to this wanted to reach out and potentially invest in Detroit or maybe Florida, like, what is the process?
Well, we're here to help. That's the first step, So we have a website, US Properties.CA. You can go on and take a look at some of the examples of what we're doing in Detroit, and there's an area where you can submit a request for contact, I pick them up and reply to everyone. Or of course, you can just reach out to me directly at James Lloyd at US Properties.CA. And we get back to you. Usually it starts by me sending some initial documents and some marketing materials about what we're doing. And then we'll set a time to speak, have an initial contact, whether on Zoom or a phone call. And we could just start by just going over what it is that you're looking for, how we could help. And then we just take it step by step, slowly. We can introduce you to our US attorneys who can help with some questions on taxation. People often have those questions. They say, this sounds great, but I want to make sure that you guys are set up so I'm not getting double taxed, et cetera. And then we just guide you through it. And once everything is good to go, we start the process. Wojtek's doing a great job of curating really good quality properties for our investors. And I think that really helps with some of that risk minimalization that we were talking about. I think we really do focus on better quality properties and better quality neighborhoods, much more into quality than quantity. And through that, when you put the government tenant program in, it really is a very stable investment. So you just reach out to us directly. I'm here to help.
Okay. All right. Awesome. So the price of admission, I guess, is the 30% down plus or minus closing costs and whatever fees there are along the way. Does that sound about accurate?
That's right.
Yeah, I mean, look, we still have a bunch of investors doing it both ways. Some people really say, I can come in with a cash investment and stretch that money through refinancing over and over again, and that seems very attractive. And there's others who come in and say, I'd like to take the advantage of the power of leveraging, and we're here to help. We have lenders, so whether you want to finance or refinance or buy cash, we can help you.
Awesome. Okay, cool. Thanks for that. So the next part is the lightning round. I'm going to ask you 5 questions. I may switch them up since you've been on the show for a few times now and you probably have similar answers. Are you ready to play?
Yes.
All right. So question number 1, right now, how are you spending your summer?
Well, I'm here in Toronto. I'm working a lot. We're busy, and I play an active role in the company. Also, spending some time with my young son, and we try to get outside and enjoy the weather by playing tennis and swimming. Right? It's a short season, but we sure enjoy it as much as everybody else.
Okay, Wojtek?
Yeah, playing tennis, lots of sports activities for the kids. Some cottaging. In Costa Rica, hopefully at the end of August, we're just planning that now for a week or so.
Okay.
And hopefully Manhattan for the US Open for a few rounds at the end of August. So excited about that.
Nice. Sounds fun. Okay, question number 2. Aside from obviously investing in similar types of properties as your business, what are you guys investing in personally? I mean, it could be paper assets, it could be Bitcoin, it could be real estate, different types of real estate. Who wants to start?
I can start. For me, it's nothing. We don't have anything in the stock market. We don't invest in Bitcoin. No stocks, nothing. It's all in real estate.
Okay. And what kind of strategy? Is it all in Detroit as well?
Primarily in Detroit, some assets in Florida, some vacation stuff in Tremblant, and we're doing a little bit in Europe, in Barcelona, that's starting. But it's been primarily focused in Michigan.
Okay. All right. What about you?
Yeah,
Jake?
I don't have a huge asset portfolio of investments as of yet, but I'm really looking to start investing heavily into Michigan. That's obviously the plan. I see it firsthand for so long now. So I'm preparing for that this year. That's really the main course of where I'm looking to go.
Okay. All right. Number 3. So Wojtek, I know you started this business, but how did you guys meet? I'm curious.
So we met in junior high school many years ago in grade 7. So we were I think we were in the same homeroom. So we've been friends ever since.
Cool. All right.
Yeah, it goes back like 35 years. It's a long time. We've been close friends ever since, and really have worked well together. For many years now. So it's awesome.
Okay. All right. Cool. Number 4. What are your 3 ideal clients' attributes that you like to work with? Like, I'll leave it open so you can kind of, go whichever direction, but what are like 3 things that you're like, I want to work with this client?
Optimistic, for sure. Like optimism. Somebody who's enthusiastic, right? Who sees an opportunity, that wants to do something, like can look at this and while realizes that it's real estate and there could be risks involved, or more than anything else is just wants to get involved in it, as maybe we wanting to do it, and is just willing to step forward and really, give it all they have into their first investment or continue to invest. I love that stuff, right? We work with those people all day. I love the optimists.
Yeah, and I think people who are, entrepreneurial and who have long-term vision and who you really want to, make real estate a vehicle to change their lives, and and who are, some people who are looking to get out of jobs that they don't like and that that are causing them grief, and would like to experience freedom that comes from investing in real estate.
Okay. All right, cool. Number 5. I just make these up as I go along because why not? It's fun. What's a fun fact that most people don't know about you?
Sorry, the Wojtek.
I need a second on this one. I think you should go first.
What's a fun fact you don't know about me? I don't know.
What about the comedy? What about the Yuck Yucks comedy on Mondays, James?
Well, I like to keep it. I do like to joke around and stuff like that. I'm really responsible, I think, for the most part in this company these days. I do take care of a lot of factors about it, but I do like a good joke, So, we're always trying to have a good time with it. And I think
are you like going to amateur night at Yuck Yucks? Is that what Wojtek was saying?
He thinks I should be going to amateur night at Yuck Yucks. Okay. He's always telling the customers, I like to pick up the nuances about people and joke with them and stuff like that. So it's good. I think it's a good dynamic to have.
All right, cool. Wojtek, what about you?
I think for me, I love to vacation. I love going to places. I spend a lot of time in Ibiza in Spain. I really like it there. Maybe I'll retire there one day. So yeah, I think that's a good one.
Okay. All right, cool. Thanks for playing the lightning round. I know you mentioned it, James, but if somebody wants to do their research and reach out, the best way to do that is?
Check us out at US Properties.CA. Make a submission through our website. We pick up all of them. Okay, so don't worry. I'll get back to you. Wojtek will pass over the submission to me, or you can reach out to me directly at James Lloyd, LLOYD, at USProperties.CA.
Okay, amazing. Thank you guys so much for being on the show. Again, it was a pleasure having you on, and congrats on all your success and building a business, right? Which is separate than real estate. It's real estate, but it's a business that's growing as well. So congrats on that. I know it's a lot of work.
Thank you so much, Sarah.
Thanks so much. I really appreciate having us on the show.
Yeah, thank you for all your support.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?